Tesla reported Q3 earnings over a month ago, and long story short, it wasn't a really good quarter, which is why the stock dropped nearly 10% the following day. And a couple of weeks ago, Tesla held its Cybertruck event and finally delivered its first Cybertruck after 4 long years ever since the company unveiled the electric pickup truck back in 2019. So after looking through its Q3 results and initial Cybertruck numbers, I can't help to notice a few major problems that Tesla followers might want to know. So that is what I'll be covering in today's video. But before we move on, if you like to read the article version of this analysis, you can find the link to my Tesla article in the description box below, where I cover Tesla in much more detail. So do check that out. And with that out of the way, let's take a look at Tesla's Q3 results. Looking at growth or lack thereof, revenue was $23.4 billion in Q3, which is up only 9% year over year. This actually missed analyst estimates by $790 million, which is concerning because Tesla has now missed revenue estimates 4 times in the last 5 quarters. Even worse, growth decelerated meaningfully from 47% in Q2, and this marks the first time in 3 years where growth dropped below double digits. And Tesla's automotive segment, which accounts for more than 80% of revenue, grew slower than the overall company, up only 5% year over year to $19.6 billion. Regardless, the slight growth in automotive revenue was due to a 27% increase in deliveries, which was 435,000 in Q3. This includes a 29% year-over-year increase in Model 3 and Y deliveries, partially offset by a 14% year-over-year decline in Model S and X deliveries. But as you can see, even despite lower average selling prices, deliveries have slowed down significantly in Q3, largely driven by high interest rates. It's also important to note that Q3 production slowed down as well, from 86% in Q2 to just 18% year-over-year growth in Q3 to 430,000 cars produced, largely due to temporary shutdowns for factory upgrades. But despite the slowdown in production and deliveries, Tesla's market share continued to expand sequentially across all regions, which is a testament to the company's superior EV offering and value. In other news, Tesla's EV network continues to grow rapidly, with Tesla locations, mobile service fleet, supercharger stations, and connectors showing robust growth year over year, as you can see at the bottom right here. So as the global fleet expands, more customers will utilize these ancillary services. And this should drive strong growth for Tesla's services and other segment, which is what we continue to see in Q3, growing by 32% year over year to $2.2 billion of revenue. Despite the strong growth, we may see this segment accelerate in future quarters as Tesla continues to gain traction for its supercharger network, signing new deals with legacy automakers like Toyota and Subaru recently. Moving on, Q3 energy generation and storage revenue was nearly $1.6 billion, up 40% year over year, and although it is slowing down quarter over quarter, 40% growth is still very strong. That said, growth for the segment was mainly driven by surging Megapack deployments. As you can see, Q3 storage deployed increased 90% year over year to almost 4 gigawatt hours, which also happens to be the company's highest quarterly deployment ever. In contrast, Q3 solar deployed dropped 48% year over year to just 49 megawatts, and this is not surprising given the fact that the whole solar industry is facing an inventory oversupply due to lower demand as a result of high interest rates. That being said, demand should pick up once again eventually, especially when the Fed begins cutting interest rates next year, but for now, I think the solar segment will continue to struggle. If you want to learn more about the challenges in the solar industry, you can watch my recent video on Enphase, which is one of the biggest solar players today. So if you're interested, I'll leave the link to that video in the description box below. That said, both the auto and solar industry are cyclical, and given the high interest rate environment that we're seeing today, it's no surprise that there's a major demand slowdown for high-ticket purchases such as cars and solar equipment. However, I think we're near the bottom of the interest rate cycle as inflation cools and the Fed stops hiking interest rates. As the macro situation continues to improve, the Fed should begin cutting rates, and as a result of that, Tesla should return to strong growth, much like what we've seen in previous years. Moving to profitability, Q3 gross profit was $4.2 billion, which is down 22% year over year, and this represents a gross margin of just 18%. As of recently, gross margin has been on a decline due to lower average selling prices on Tesla's vehicles. I mean, it's reasonable for Tesla to cut prices and sacrifice margins in return for upsized growth, but in Q3, revenue only grew by 9% year over year, while gross margin dropped by 700 basis points year over year, which is not good at all. Breaking it down by segment, we can see that the automotive segment is the main culprit for the overall margin decline, with a gross margin of just 19%, down from its peak of 33% due to the price cuts that I've just mentioned. But do note that Tesla is sacrificing margins today to gain as much market share as possible. On the other hand, the energy generation and storage segment became the most profitable segment with a 24% gross margin in Q3, up by 1,500 basis points from 9% a year ago. So that's really good progress for the Tesla energy business. As for the services and other segment, gross margin was 6% in Q3, which is pretty much flat over the last few quarters. On the bright side, Tesla's cost of revenue per vehicle continues to drop quarter over quarter, even despite macro headwinds, factory shutdowns, and ongoing ramp at new factories. That said, I believe Tesla can continue to reduce cost per vehicle as macro conditions improve and as the company ramps up production. Subsequently, automotive margins should bottom as well. Moving down the income statement, net income is unsurprisingly getting worse as well, which was $1.9 billion in Q3. This represents a net income margin of just 8%, which has been declining over the last few quarters due to lower average selling prices, higher expenses to fund projects like Cybertruck and AI, temporary factory inefficiencies, as well as a negative FX impact of $0.4 billion. Then again, Tesla is investing heavily for growth, and that's why margins are under pressure. Of important note, Tesla's net margin has fallen to a point where Tesla is now blending with the rest of the industry. It used to be higher than the rest of the industry, but now it's just right in line with the industry, which may be a sign that Tesla's cost advantages moat may be weakening, so keep that in mind. All in all, Tesla is sacrificing short-term profitability for long-term growth, but the problem is Tesla is not growing as fast as it should, considering its recent price cuts. Fortunately, Tesla continues to gain market share, which is management's topmost priority, and with more Tesla cars in the hands of customers, Tesla can cross-sell high-margin products such as FSD, which should boost Tesla's long-term margins and earnings potential. Turning to the balance sheet, Tesla has a fortress balance sheet with $26.1 billion of cash, $8.2 billion of total debt, which puts its net cash position at about $17.9 billion. As you can see, despite the challenging macro environment, Tesla's net cash position continues to build up over the last few quarters, solidifying its financial position. It's also worth mentioning that Tesla has a very low debt position of just $8 billion compared to some of its competitors such as Ford, GM, and Toyota, which all have more than $100 billion of debt each. And this is why Tesla has a huge financial advantage over competitors. In other news, inventory, which is the purple line right here, took a slight dip in Q3, likely due to the temporary factory shutdowns. But notice that inventory has been building up over the last few years, and that's common as a company scales. But notice that days inventory outstanding, which is the orange line right here, has been on the rise as well, which means that it's taking longer for Tesla to sell its cars. As you can see, back in 2022, it took an average of 40 days to sell its inventory, and today it's as high as 67 days. So maybe that is why Tesla is cutting prices, so it can clear inventory faster. Moving on, Q3 free cash flow was $0.8 billion, which is a 4% free cash flow margin, which has been on a decline as well, as you can see right here. That's understandable considering management's focus on growth. That said, Tesla has a highly capital efficient business model with low debt, positive net cash, and positive free cash flow, which gives the company a strong financial advantage over competitors, both in good and bad times. For 2023, management expects to remain ahead of their long-term 50% CAGR target with around 1.8 million vehicles produced for the year. Now, Tesla produced around 1,351,000 vehicles in the first 3 quarters alone, which leaves around 449,000 vehicles that need to be produced in Q4 in order for the company to reach its 2023 target of 1.8 million vehicles. Now, assuming Tesla produces 449,000 vehicles in Q4 and delivers the same amount at an average selling price of 45,000, which is the exact figure in Q3, then Tesla should generate around $20.2 billion of revenue in Q4, which is a 2% year-over-year decrease. Given the high interest rate environment and lower average selling prices, we could potentially see overall Q4 growth drop to negative territory for the first time in over 3 years, so don't be surprised if that happens. Whatever it is, Tesla still has a long growth runway due to several secular trends such as EVs, solar, and AI, just to name a few. There's also the Cybertruck, which was recently launched a few weeks ago. I know there's a lot of hype around the Cybertruck, but I don't think it will make a huge impact on the company's growth, at least in the near term. Here's why. During the Q3 earnings call, Elon said that the Cybertruck has over 1 million people who reserved the car. He also said that the company will end up with roughly 250,000 Cybertrucks produced a year, not in 2024, but probably sometime in 2025. In addition, management pointed out that Tesla has an initial capacity of at least 125,000 Cybertrucks. And with this information, I see 4 major problems for the Cybertruck. First, assuming 125,000 units in 2024 and 250,000 units produced in 2025 and beyond, person number 1 million on the wait list would have to wait at least 4 more years to get his or her Cybertruck, which is a really long wait. Second, the 1 million reservations that Elon mentioned were made with a refundable deposit of $100. In addition, those reservations were made with the expectation that the Cybertruck would sell for $40,000. However, Tesla just revealed that the base model will start at $61,000, which is 50% higher than initially promised. As such, there's reason to believe that a lot of people will be refunding their deposits due to the higher price tag, which means that demand for the Cybertruck may not be as high or as strong as management claimed. The third problem is that the mid-tier Cybertruck has a price tag of $80,000, which is similar to the Model S and X. And if we go back to Tesla's production numbers, we can see that Tesla produced about 80,000 Model S and X vehicles from Q3 of 2022 to Q2 of 2023. So we add these 4 numbers, we get 80,000 Model S and X produced in a year, and I'm not counting the latest quarter since there were temporary factory shutdowns for upgrades. That said, because of the similar price tag, I expect the Cybertruck to have around the same production rate as the Model S and X, which is around 80,000. I would say a more realistic number is around 100,000 a year. However, 250,000 Cybertrucks a year just doesn't make sense. And finally, high interest rates may continue to put immense pressure on demand. Even though inflation has cooled down over the past year, it has not fallen below the Fed's inflation target of 2%. So it's likely that interest rates will remain higher for longer. Even Elon Musk is worried about the high interest rate environment, and I think we should all be worried as well. So given these 4 problems, I don't think Cybertruck sales will be strong in the next couple of years. Having said that, despite slowing growth, Tesla's long-term outlook remains as bright as ever as Tesla continues to be the most dominant force in sustainable energy solutions. In addition, the company continues to invest heavily in several exciting projects including Dojo in the chips industry, Optimus in the robotics industry, and FSD in the autonomous driving industry, all of which could unlock massive value for Tesla shareholders. Looking at Tesla's valuation, the stock is trading at an EV to revenue multiple of 7.8 times, which is lower than its 5-year average of 10.4 times and its highs of 26.6 times. So from a historical standpoint, Tesla stock looks slightly below fair value. However, the lower multiple is justified given Tesla's slowing growth rates, lower margins, and weak near-term outlook. And despite all that, Tesla stock is still trading more expensively compared to pre-pandemic levels, so I'm pretty mixed in terms of Tesla's valuation multiple. In addition, Tesla is trading at a forward PE ratio of 61 times, which is quite expensive and is something not to be ignored. It's more expensive than the rest of the Magnificent Seven companies, as you can see right here. It's 50% more than Nvidia, and it's trading over 2 times more than companies like Apple, Google, and Amazon. So whether you value Tesla as a car company or a solar company or a tech company, there's no denying that Tesla stock is richly valued and priced to near perfection. Turning to my price target on Tesla, I currently estimate an intrinsic value per share of $222 per share for Tesla, which is not much different from its current price of $244. While I do like Tesla as a long-term investment, I think valuation is rich, the outlook seems cloudy, and growth is slowing down. So I don't think there's a wide margin of safety to make it a good buy. However, Tesla may continue to trade expensively due to its high-quality business model and strong competitive moat, so take my price target with a grain of salt. Also, if you're interested in how I arrive at this price target, I provide details of my DCF model in my article, so definitely check that out. Wrapping up this video, as we've seen with Q3 results, we can see that Tesla's growth is slowing down significantly due to factors such as high interest rates and lower average selling prices. And to make matters worse, margins are declining as well. The Cybertruck might be the catalyst that bring Tesla back to strong growth. However, given the high interest rate, high price tag, and high expectations, I think demand for the Cybertruck will not be as strong as anticipated. Don't get me wrong, I'm bullish on Tesla, but I think high interest rates and Cybertruck complexities will challenge Tesla's growth ambitions in the near term. But despite today's challenges, Tesla continues to dominate in renewable energy solutions and is at the forefront of multiple mega trends such as solar, EVs, and AI. And Tesla has very low debt, which positions it well for an economic downturn if we do see one in the near future. With that being said, what are your thoughts on Tesla and the Cybertruck? Please let me know in the comment section down below. Otherwise, that's all that I have for you today. If you enjoyed this video, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next video.